All right. Well, here now is the fabulous, the smart, the handsome Congressman Andy Barr. Andy Barr, good to see you. Andy sits on, the congressman sits on the Financial Services Committee and is the chairman of the subcommittee on financial institutions. This is right up your alley, the SVB. So, Congressman, what is the GOP Congress's plan to deal with this cascading set of events of bank failures?
Well, Sean, thanks for having me on the program and Dagen. But first and foremost, Congress and specifically our committee, the committee on which you formerly served, our job is robust, vigorous oversight over the financial regulators responsible for preventing systemic risk. We anticipate not only continued briefings from the regulators related to the resolution of Silicon Valley Bank and some of these other bank failures, but also hearings about what was the cause. Now, you've heard the President, Elizabeth Warren, other progressives blame deregulation, bank deregulation, or some of the fixes that we made, you and I together when you were on the committee, to the Dodd-Frank Act. But let me be crystal clear to anyone and everyone who's listening to this program. The failures of these banks, Silicon Valley Bank and Signature Bank, had absolutely nothing to do with insufficient regulation. It did have everything to do with substandard and failed bank supervision. Now, what's the difference between regulation and supervision? Regulation, think of regulation as making the rules governing banking. Supervision is about enforcing those existing rules. And the existing rules in place that applied to Silicon Valley Bank were totally sufficient for the bank regulators to prevent this from happening. There were many, many red flags for the San Francisco Fed, and the San Francisco Fed was the primary bank supervisor of this institution, to identify a problem brewing, and they did nothing about it. And in fact, the Silicon Valley Bank CEO served on the San Francisco Bank board. And so you've got to ask questions about that. But this was a bank that grew, the asset size grew rapidly. It doubled in size in just a year. It quadrupled in size since 2019. It relied heavily, in fact, overly reliant on uninsured deposits. 90% of the deposits were uninsured. There was interest rate exposure, massive interest rate exposure, and no hedging on the part of bank management. That's a head scratcher. Why the San Francisco Fed didn't ask questions about that? The Silicon Valley Bank was the #1 borrower from the Federal Home Loan Bank of San Francisco, the San Francisco Federal Home Loan Bank. And then the bank didn't have a chief risk officer for 8 to 9 months. What on earth was the regulator doing? This is not about insufficient rules. It's about horrible bank supervision.
Congressman, the Justice Department and the Securities and Exchange Commission both investigating the collapse of Silicon Valley Bank. I think all the American people would like to know who contacted people in the administration to get all of the depositors at this bank for the very wealthy, indirectly or directly. The wealthiest little nugget of this nation got bailed out, 100% of deposits made whole. Will you get to the bottom of who was contacting people in D.C. over the weekend to get this very bailout?
We definitely want to learn more about that. We also want to learn about why over the weekend the bank couldn't find a purchaser. Mm-hmm. And we have a searching questions for the regulators themselves about whether or not they thwarted the possible purchase of this bank, this failing bank, and whether or not their political agenda about not wanting larger institutions to take over this bank prevented a private sector solution to this problem and resulted in this these extraordinary measures that the regulators had to take. I will say, and I think this underscores our point here, that the fact that the regulators had the tools over the weekend, even if they did thwart a purchase by a larger institution, the fact that they had these measures in place, the 13.3 liquidity facility from the Fed and then the systemic risk exception from the Fed that provided the ability of the regulators to provide insurance or to cover the uninsured depositors, those are pre-existing authorities. So the idea that the regulations were the problem is nonsense. The regulators had all the tools that they needed, even after they failed to supervise the bank correctly. And so this is not a problem of lack of regulations. In fact, if anything, I think we need to review whether or not the regulations that pre-existed this crisis actually create moral hazard, and we might want to revisit those.